Private credit is quietly becoming one of the most dangerous forces in the global financial system, and almost nobody is talking about it. While mainstream media focuses on stock market and interest rates, there is a shadow lending world growing at a terrifying pace, completely hidden from public view. We are talking about trillions of dollars in private loans made between wealthy investors and corporations, with zero transparency, zero regulation, and zero safety net. And right now, this market is showing the exact same warning signs that appeared before the 2008 financial crisis, before the dot-com bubble, and before every major economic collapse in modern history. So today we are going to pull back the curtain on private credit, expose how it really works, who is behind it, why it is growing so fast, and most importantly, why it could be the trigger for the next global financial catastrophe. To understand why private credit is so dangerous, you first need to understand what it actually is. Most people think of credit as something you get from a bank. You walk in, you fill out some forms, the bank checks your income and credit score, and if everything looks good, they give you a loan. That loan is regulated. The bank has to keep a certain amount of capital in reserve. There are rules about how much risk they can take. Government agencies watch over every move they make. Private credit is nothing like that. Private credit happens when a non-bank lender gives a loan directly to a company or individual completely outside the traditional banking system. These lenders are typically large asset management firms, hedge funds, pension funds, and insurance companies. They pool together money from wealthy investors and institutions, and then they lend it out to businesses that either cannot get loans from banks or do not want to deal with the regulations and restrictions that come with bank lending. The borrowers are usually medium-sized companies, sometimes called middle-market businesses. These are not tiny startups, and they are not giant corporations listed on stock exchanges. They are businesses in the middle that generate real revenue but are considered too risky or too complex for traditional bank loans. And the terms of these private credit deals are not public. There is no stock exchange reporting them. There is no government database tracking them. These deals happen in private between two parties, and the rest of the world has absolutely no idea what is going on. Now here is where things start to get really interesting and really scary. The private credit market has exploded in size over the last 15 years. Back in 2010, the total amount of private credit assets under management globally was around $300 billion. By 2020, that number had grown to about $800 billion. And today, in 2024, estimates put the total size of the private credit market at over $1.7 trillion. Some analysts believe it could hit $3 trillion within the next 5 years. Think about that for a moment. We are talking about a market that has grown by more than 500% in just over a decade. A market with almost no public oversight. A market where losses can be hidden for months or even years before anyone outside the deal even knows there is a problem. A market that is now so large that if even a fraction of these loans go bad, the shockwaves could spread through the entire global financial system. Take Huawei. To really understand why this is so dangerous, you need to go back in time. You need to understand what happened in 2008. And why the conditions that exist today are so eerily similar to what existed back then. The 2008 financial crisis was not just about bad mortgages. Yes, subprime mortgages were the spark, but the real fuel that turned a housing correction into a global catastrophe was something called securitization and leverage. Banks were taking mortgages, bundling them together into complex financial products called collateralized debt obligations or CDOs, and selling them to investors around the world. The problem was that these products were so complex that almost nobody truly understood what was inside them. Rating agencies were giving these toxic bundles of bad mortgages AAA ratings, the highest possible rating reserved for the safest investments. Investors bought them believing they were safe. And when the mortgages started defaulting, the entire system unraveled with terrifying speed. Now look at private credit today. The same patterns are emerging. Private credit loans are being bundled together into new complex financial products called collateralized loan obligations or CLOs. These CLOs are then being sold to pension funds, insurance companies, and other institutional investors around the world. Just like in 2008, many of the investors buying these products do not fully understand what is inside them. Just like in 2008, the ratings on these products may not accurately reflect the true level of risk. And just like in 2008, the sheer complexity and interconnectedness of the system means that when something goes wrong, it will not stay contained. It will spread. The growth of private credit did not happen by accident. It was the direct result of decisions made by governments and central banks in the aftermath of the 2008 financial crisis. After the crash, regulators rightly concluded that banks had been taking too much risk, so they introduced strict new regulations through legislation like the Dodd-Frank Act in the United States and Basel III internationally. These new rules required banks to hold more capital in reserve, limited the types of loans they could make, and generally made it much harder for banks to lend to riskier borrowers. The intention was good: make banks safer, prevent another crisis, but there was an unintended consequence. All of those businesses that used to get loans from banks now had nowhere to turn. Medium-sized companies with slightly below perfect credit histories, businesses in volatile industries, startups that needed growth capital. Banks were no longer willing or able to lend to them, so a new industry stepped in to fill the gap. Private credit managers realized there was an enormous opportunity. These businesses needed loans and they were willing to pay high interest rates to get them. And unlike banks' private credit funds did not face the same regulatory restrictions, they could lend more aggressively, take more risk, and charge higher fees. And the investors who funded these private credit managers were happy to participate because in a world of near zero interest rates, the high yields offered by private credit were extremely attractive. So the market grew and grew and grew. The problem is that higher yields always mean higher risk. When private credit managers offer investors returns of 10 or 12 or even 15% annually, that sounds incredible. But those returns come from lending to companies that cannot get money anywhere else. Companies that banks have already looked at and decided are too risky to lend to. Think about what that means. The borrowers in the private credit market are by definition the riskiest borrowers in the economy. They are companies with too much existing debt, too little cash flow, too uncertain a future. I know they are borrowing even more money at very high interest rates. When the economy is growing and interest rates are low, these companies can just barely manage their debt payments. But when the economy slows down, or when interest rates rise, those same companies suddenly find themselves in serious trouble. And that is exactly the situation we are in right now. Interest rates have risen dramatically over the past 2 years. The global economy is slowing, and the companies that took on private credit loans during the boom years are now struggling to make their payments. Shh. Let us talk about the people behind private credit, because this is not some abstract financial mechanism. There are real names, real firms, real functions involved. The private credit boom has been led by a handful of enormous asset management firms that you may have heard of, even if you do not fully understand what they do. Blackstone, Apollo Global Management, Ares Management, Blue Owl Capital, and KKR are among the biggest players in the private credit space. These are not small operations. Blackstone alone manages over $1 trillion in assets across all of its businesses. Apollo has over $600 billion under management. These firms employ thousands of people in offices around the world. They manage money on behalf of some of the largest pension funds in the world, university endowments, sovereign wealth funds, and high net worth individuals. And they have become incredibly powerful, not just financially but politically. The executives of these firms are regular visitors to government offices in Washington, London, Brussels, and Beijing. They donate heavily to political campaigns. They serve on advisory boards. When they talk, governments listen. And that is part of what makes the private credit risk so hard to address. The people who need to be regulated are also some of the most influential people in the world. One of the most troubling aspects of private credit is the way it handles transparency, or more accurately, the way it avoids transparency. When a publicly traded company borrows money from a bank or issues bonds, those transactions have to be disclosed. Investors can see the terms of the loan. Regulators can monitor the health of the borrower. The public has access to information. Private credit operates in complete darkness. When a private credit fund makes a loan, the only parties who know the details are the lender and the borrower. The other investors in the fund only see aggregate numbers. They see a return figure and a general description of the portfolio. They cannot see the individual loans. They cannot assess the credit quality of each borrower. They cannot know how close any individual company in the portfolio is to defaulting. This lack of transparency creates what economists call information asymmetry. The managers of private credit funds know exactly how healthy or unhealthy their portfolios are. The investors who have put their money into those funds do not. And regulators who are supposed to protect the financial system have very limited visibility into what is happening. This is not a theoretical concern. There have already been several high-profile cases where private credit funds appeared to be performing well, right up until the moment they were not. Defaults happened suddenly. Investors who thought they were in a safe investment suddenly found themselves facing major losses. And the rest of the market had no warning because there was no mechanism to provide warning. Now let us talk about the leverage problem, because this is where things get truly frightening. Leverage in finance means borrowing money to make investments. It amplifies both gains and losses. If you invest $100 of your own money and the investment goes up 10%, you make $10. If instead you borrow another $900 and invest $1,000 and the investment goes up 10%, you make $100. Great. But if the investment goes down 10%, you lose $100, which is your entire original investment gone. That is the power of leverage. It magnifies everything. Private credit funds use leverage. The companies they lend to use leverage. And the financial products like CLOs that bundle together private credit loans also use leverage. We are talking about leverage stacked on top of leverage, stacked on top of more leverage. In some cases, the underlying borrowing companies are carrying debt loads equal to 6 or 7 times their annual earnings. That means if their earnings drop even slightly, they cannot service their debt. And when they cannot service their debt, the private credit fund that made the loan starts to have problems. And when enough private credit funds start to have problems, the investors in those funds start to face losses. And when pension funds and insurance companies start facing major losses, the effects ripple out into the real economy, where ordinary people live and work. The interest rate environment of the past 2 years has been particularly brutal for private credit borrowers. When private credit exploded between 2015 and 2022, interest rates in most developed economies were at historically low levels. The Federal Reserve in the United States had its benchmark rate near zero for years. The European Central Bank actually had negative interest rates for a period. In this environment, borrowing was cheap and even highly indebted companies could manage their debt payments relatively easily. But then inflation came roaring back, and central banks responded by raising interest rates at the fastest pace in decades. In the United States, the Federal Reserve raised rates from near zero to over 5% in just about 18 months. This was devastating for private credit borrowers for a very specific reason. Unlike most traditional bonds, which have fixed interest rates, many private credit loans have floating interest rates. This means when benchmark rates go up, the interest rate on these loans goes up automatically. A company that was paying 6% interest on its private credit loan in 2021 might be paying 11 or 12% on that same loan by 2020. For a company already carrying heavy debt loads, this kind of interest rate increase can be the difference between survival and bankruptcy. And we are already starting to see the effects. Default rates in private credit are rising. Restructurings are becoming more common. The number of so-called zombie companies that can barely make their interest payments and have no hope of paying back the principal is growing rapidly. As the term in finance called extend and pretend, and it perfectly captures one of the most dangerous dynamics currently playing out in the private credit market. When a borrower starts to struggle with their debt payments, they have two basic options. They can default, which means they stop paying and the lender has to recognize a loss. Or they can negotiate with the lender to modify the terms of the loan, maybe extend the repayment date, maybe temporarily reduce the interest rate, maybe add more money to the loan to give the borrower breathing room. From a short-term perspective, extend and pretend makes sense for everyone involved. The borrower avoids default, The lender avoids having to write down a loss. Investors in the fund do not see a drop in returns. Everybody looks good on paper. But extend and pretend is just delay and deceive. It does not solve the underlying problem. The borrower is still in trouble. The debt is still unpayable. The loss is still coming. It is just being pushed into the future, and the longer it is pushed, the worse it gets. Because interest keeps accumulating, the company gets weaker and the eventual loss becomes larger. Right now, there are widespread reports that private credit managers are doing exactly this. Extending loans to troubled borrowers, quietly restructuring deals, avoiding the form or default process that would force them to mark down their portfolios. This means the true level of stress in the private credit market is probably significantly higher than the official numbers suggest. The losses are there, they are just hidden. For now. The connection between private credit and the broader financial system is more complex and more dangerous than most people realize. Private credit does not exist in isolation. It is deeply connected to pension funds, insurance companies, sovereign wealth funds, and through them to hundreds of millions of ordinary people. Pension funds around the world have dramatically increased their allocation to private credit over the past decade. In a world of low interest rates, pension funds were desperately searching for higher returns to meet their obligations to retirees. Private credit, with its promise of 8 to 12% annual returns, looked like a miracle solution. So pension funds poured money in. Some of the largest pension funds in the world, including those that manage retirement savings for teachers, firefighters, government employees, and other public sector workers, now have significant portions of their assets invested in private credit. If private credit suffers major losses, those pension funds will feel the pain, and when pension funds are in trouble, it means real people face the possibility of reduced retirement benefits. It means teachers and firefighters and government workers who spend their entire careers expecting a certain retirement income might find that money is not there. That is not an abstract financial concept. That is a direct attack on the financial security of millions of families. Insurance companies are also deeply exposed to private credit risk. Over the past decade, insurance companies, especially life insurers, have become major investors in private credit products. They are attracted by the higher yields, which help them fund their obligations to policyholders. But insurance companies are supposed to be among the most conservative investors in the world. They manage money on behalf of people who have paid premiums expecting that their claims will be paid. When insurance companies take on excessive risk in search of higher returns, they are essentially gambling with their policyholders' money. And some of the largest private equity firms in the world have actually purchased insurance companies specifically to gain access to their large pools of investable assets, which they can then deploy into private credit investments. This creates a deeply problematic alignment of incentives. The private equity firm makes money by putting the insurance company assets into its own private credit funds. The insurance company earns high returns in the short term, but the policyholders whose money is ultimately being invested are taking on far more risks than they realize. The regulatory response to the growth of private credit has been frustratingly slow and inadequate. Financial regulators in most countries are still largely operating under frameworks designed before private credit became a major force in the financial system. The Securities and Exchange Commission in the United States has been working on new disclosure requirements for private funds. The Financial Stability Board, which coordinates financial regulation globally, has identified private credit as a potential systemic risk. The Bank of England has expressed concern about the opacity of private credit markets, but actual meaningful regulation has been slow to arrive. Part of the problem is the fundamental nature of private credit. Because these transactions happen between sophisticated parties like large institutions and wealthy individuals, regulators have traditionally taken a hands-off approach. The argument is that these are professionals who understand the risks they are taking and do not need the same level of protection as ordinary retail investors. But this argument ignores the systemic dimension. It does not matter how sophisticated the individual parties in a private credit deal are. What matters is what happens to the broader financial system if thousands of these deals go bad at the same time. Systemic risk is not about protecting individual investors from bad decisions, it is about protecting the entire economy from a chain reaction of failures. And on that dimension, the private credit market is almost entirely unregulated. There is another dimension to this story that rarely gets discussed in mainstream financial coverage. Private credit is not just a risk to financial stability. It is also changing the fundamental nature of corporate capitalism in ways that have profound implications for workers, consumers, and communities. When a company takes on a private credit loan to fund operations or an acquisition, the terms of that loan typically include strict requirements about how the business is managed. The private credit lender wants to make sure it gets paid back, so it imposes covenants, restrictions on how much the company can spend, requirements to hit certain profitability targets, limits on capital investment. These restrictions can significantly constrain the ability of company management to make decisions that are good for the long-term health of the business. And when companies are striving to meet their debt obligations, management faces enormous pressure to cut costs in whatever way possible. That usually means cutting jobs, reducing benefits, squeezing supplies, and reducing investment in research and development. The human cost of private credit stress is real, and it is felt by workers who lose their jobs or see their benefits cut, and by communities that lose employers who have been central to their local economies for decades. Let us talk about some specific examples that illustrate how quickly and catastrophically private credit situations can unravel. The collapse of several high-profile companies in recent years has revealed the dangers lurking beneath the surface of the private credit market. Companies that appeared financially stable suddenly disclosed massive debt problems. Private credit funds that had been reporting steady returns suddenly announced significant losses. Investors who believed their money was safely deployed found themselves unable to exit their positions because private credit is by nature illiquid. Unlike publicly traded stocks or bonds, you cannot simply sell a private credit investment when you need your money back. You are locked in for the duration of the loan. This illiquidity mismatch is one of the most dangerous aspects of private credit. Some investment products that give ordinary investors access to private credit through vehicles like interval funds or non-traded business development companies promise periodic redemption windows. But if too many investors try to redeem at the same time, the fund may not have enough liquid assets to pay everyone. This creates a potential for a classic bank-run dynamic. Investors think that others are trying to get their money out, rush to the exit themselves, which makes the problem worse, which causes more investors to panic, which accelerates the crisis. The global interconnectedness of private credit adds another layer of complexity to the risk picture. Private credit is not just a problem in the United States. The market has grown explosively in Europe, Asia, and other regions as well. European private credit assets under management have gone from negligible amounts a decade ago to hundreds of billions of euros today. Asian private credit is growing rapidly, with markets like Australia, Japan, South Korea, and increasingly India and Southeast Asia seeing major inflows. This global reach means that a crisis in private credit would not be contained within any single country. Just as the 2008 financial crisis that originated in American mortgage markets quickly spread to banks and financial institutions around the world, a private credit crisis could spread through the global financial system with terrifying speed. The international banks that provide leverage to private credit funds operate across borders. The institutional investors in private credit funds are globally diversified. The companies that have borrowed through private credit markets operate in multiple countries. When the problems start, it will not stay local. And two, one of the most insidious aspects of the private credit bubble is how it has been normalized. When a market grows steadily for 15 years, it starts to feel normal. Investors who have collected healthy returns year after year start questioning whether those returns are sustainable. Managers who have never experienced a major downturn in their portfolios start to believe they have developed foolproof lending strategies. Regulators who have watched the market grow without triggering an obvious crisis start to wonder whether their concerns were overblown. This normalization of risk is itself a major danger signal. Every financial bubble in history has been preceded by a period in which the participants convinced themselves that this time was different, that new tools, new technologies, or new financial instruments had eliminated the old risks. In the 1990s, it was a new economy. In the 2000s, it was financial engineering and diversification. Today, in the private credit market, it is the sophistication of the borrowers, the expertise of the lenders, and the supposed diversification of the portfolios. But the fundamental laws of finance have not changed. Money lent to risky borrowers at high interest rates will eventually generate significant losses. The only question is when. The Federal Reserve and other major central banks are in an incredibly difficult position when it comes to private credit. On one hand, they know the market represents a significant systemic risk. On the other hand, private credit has become an important source of financing for thousands of businesses across the economy. If the private credit market suddenly freezes up the way the traditional credit markets did in 2008, the consequences for economic growth and employment could be severe. So, central banks face a terrible dilemma: act too aggressively to address the risks in private credit, and you might trigger the very crisis you are trying to prevent. Act too cautiously, and you allow the risks to continue building until they explode on their own terms. This is not a new dilemma. Central banks faced exactly the same challenge with housing in the early 2000s, with technology stocks in the late 1990s, and with emerging market debt in the late 1990s. In most of those cases, the response was too little too late, and the result was a crisis. There is no particular reason to believe the outcome will be different this time. Let us also consider the role of private credit in what economists call financialization, the process by which financial actors, financial motives, and financial institutions gain greater influence over the broader economy. Private credit is part of a broader shift in which traditional banks have been gradually displaced by a vast shadow banking system of private funds, specialized lenders, and complex financial intermediaries. This shadow banking system is in many ways more efficient than traditional banking. It can respond more quickly to market opportunities. It can serve borrowers that banks cannot or will not lend to. It can generate higher returns for investors, but it lacks the stability mechanisms that have been built into the traditional banking system over decades of painful experience. When a traditional bank runs into trouble, there are well-established procedures. Regulators can step in. The FDIC can guarantee deposits. The Federal Reserve can provide emergency liquidity. These mechanisms are far from perfect, as 2008 demonstrated, but they do exist. For private credit, there are no comparable safety nets. If a major private credit fund encounters serious trouble, there is no federal insurance protecting investors. There is no established mechanism for an orderly wind down. There is no lender of last resort standing by to provide liquidity. The system would have to rely on improvisation at exactly the moment when improvisation is most dangerous. The technology and data revolution has added another dimension to the private credit risk picture. Over the past decade, private credit managers have increasingly used sophisticated data analytics and algorithmic tools to assess creditworthiness and manage their portfolios. These tools have allowed them to process more loans more quickly with smaller teams. They have helped identify risk factors that traditional analysis might miss, and they have contributed to the general confidence that the private credit market is being managed with greater sophistication than ever before. But algorithmic models are only as good as the data they are trained on, and the data available to train private credit models covers primarily the period from about 2010 to the present. That is a period of exceptionally low interest rates, strong economic growth, and very few major credit crises. Models trained on this data may be systematically underestimating the risks that arise in different economic environments. They have never been tested against a prolonged recession. They have never been tested against a sustained period of high inflation and high interest rates. The combination of conditions we are now experiencing is essentially unprecedented in the data that these models were built on. This means the risk management systems that private credit managers rely on may be far less reliable than they appear. The political economy of private credit is also important to understand. The firms that dominate the private credit market are not just financial powerhouses, they are major political players. The executives of Blackstone, Apollo, Ares, and their peers sit on corporate boards, advise governments, and make significant political donations. They have every incentive to resist meaningful regulation of their industry, and they have the financial and political resources to do so effectively. Meanwhile, the potential victims of a private credit crisis are diffuse and largely unaware of their exposure. The pensioner whose retirement fund has invested heavily in private credit does not know it. The policyholder whose insurance company has moved into private credit investments does not know it. The small business owner who might be affected by a credit crunch if the private credit market freezes does not know it. This information asymmetry between the concentrated interests of the private credit industry and the diffuse interests of those who might be harmed by a crisis makes it very difficult to build political support for reform. The people who benefit from the status quo are organized, powerful, and motivated. The people who might benefit from reform are unorganized, unaware, and diffuse. This is a classic dynamic in financial regulation, and it rarely ends well. It is worth stepping back and asking a fundamental question. Why does private credit exist at all? The honest answer is that it exists because it fills real needs in the economy. There are businesses that need capital that banks are not willing or able to provide. There are investors who need returns that traditional fixed income markets cannot deliver. Private credit brings these two groups together, and that is genuinely valuable. The problem is not the existence of private credit. The problem is the explosive unregulated growth of private credit at a time when economic conditions are becoming increasingly challenging. The problem is the opacity, the leverage, the interconnectedness, and the lack of any meaningful safety net. Hello 1 2 3 my testing, my UPV testing, Martini, and maintains reasonable levels of leverage could be an important and healthy part of the financial ecosystem, but that is not the market we have. The market we have is one that has grown too fast, taken on too much risk, avoided too much oversight, and become too interconnected with the rest of the financial system to fail cleanly if things go wrong. ETAC. The warning signs are already visible to those paying attention. Default rates are rising, restructurings are becoming more frequent. The extend and pretend dynamic is creating a growing backlog of hidden losses. The companies that took on private credit loans during the boom years are struggling with their debt service in a world of higher interest rates and slower growth. Major investors are starting to pull back. Some of the most sophisticated pension funds and endowments have begun reducing their exposure to private credit. A few brave analysts and economists have started writing about the systemic risks publicly. The International Monetary Fund has flagged private credit as a potential source of financial instability. The Bank for International Settlements, which coordinates among central banks, has issued warnings. Even some people within the private credit industry are quietly acknowledging in private conversations that the market has grown too large too fast and with too little discipline. The question is not whether the private credit market will face serious stress. The question is whether that stress will be managed in a way that is orderly and contained, or whether it will spiral into a broader financial crisis. The answer depends on decisions being made right now by regulators, policymakers, private credit managers, and institutional investors. If regulators move quickly to require greater transparency, to limit leverage, and to create some kind of orderly resolution mechanism for distressed private credit funds, it might be possible to deflate this bubble gradually and relatively painlessly. If institutional investors exercise genuine discipline and hold private credit managers to higher standards of transparency and risk management, that too would help. But if the extend and pretend continues, if regulation remains inadequate, and if the market continues to grow, while the underlying stress builds, then the eventual reckoning will be far more severe. History teaches us that financial crises are always obvious in retrospect and almost invisible in prospect. In 2006, almost nobody was predicting that American housing markets would collapse and take the global financial system with them. In 1999, almost nobody was predicting that internet stocks would lose 90% of their value. In 2007, almost nobody was predicting that the complex financial instruments built on subprime mortgages would turn out to be essentially worthless. In each of these cases, there were people raising concerns. There were warning signs being ignored. There were risks being underestimated. And there were powerful interests that benefited from keeping everyone calm and keeping the party going. Private credit today has all of these characteristics. There are real concerns being raised by serious people. There are visible warning signs. There are risks that are almost certainly being underestimated both by the markets and by the models. And there are very powerful interests that have every reason to keep everyone calm, to avoid scrutiny and to let the market keep growing. Whether we learn from history or repeat it remains to be seen. But the evidence suggests we should be paying a great deal more attention to what is happening in the shadows of the global financial system than most of us currently are.